Well, batten down the hatches. The economic apocalypse is coming, if you believe my next guest. Professor Steve Keen was famously wrong when he called a catastrophic crash for Australian house prices following the GFC. He's now predicting a recession for 2017 and says there's no doubt he's right. Steve Keen says the Reserve Bank doesn't know what it's doing on rates, and we have the most overvalued property market on the planet, and the country is facing a massive credit crunch. I spoke to the professor earlier. Professor Steve Keen, welcome to the program.
Lovely to be here.
You say Australia will be in recession shortly, probably next year. Why?
Because we've lived on credit, and I don't mean government credit, I mean private credit, for the last 8 years, ever since the financial crisis hit. And we've borrowed ourselves so much to the hilt that we're now dependent upon that continuing to rise over time, and it simply won't, and it also simply isn't. It's that level of credit starting to fall, and when that falls, demand will fall and unemployment will rise as well.
What will burst that bubble, though?
It's simply its own mechanics, because the only way it can not burst is for the household sector in particular to continue borrowing forever more than it earns. So it's gone from owing something of the order of 20% of GDP as its household debt level back in about 1980 or 1985 to 125% now. And it now makes it the most indebted household sector on the planet. And to continue going with, as we are now, with rising credit, that has to rise even more to 150, 160% of GDP. It simply isn't going to happen. And when it slows down, the mere fact that it slows down means credit falls. And that's the real trap that the government has no idea it's walking into, and neither do those people who've been borrowing money.
So just to explain why it won't continue, because we're about to see the Reserve Bank most likely cut at least once more, which will take us ever increasingly closer to 1%. That will see our banks cut, the borrowing rates again, and credit will continue to become cheaper.
It'll suck more people in. It'll suck more people in for a while, and they can delay it by cutting the rates. I've been saying for ages the Reserve Bank didn't know what it was doing by putting up rates in the first place, causing a carry trade which made the dollar far too highly valued and decimated Australian manufacturing in the process. So they're going to be forced back to zero ultimately, which they've been resisting against the trend of all other central banks around the world. But they've only got 1.5% to go. Once you get to that level, you can't start giving people, I think they should give money away. That's part of my argument about how we get out of this problem. But they were not going to have negative interest rates to pay you money to borrow. That's not going to happen. So consequently, there's just a maximum they can squeeze out of us, and when they hit that point, the household sector is going to be indebted up to its teeth beyond anything Australia's households have ever had before, any households globally have ever had before, and they are simply not going to continue borrowing.
So what's going to be, normally when there's a recession, there is some sort of catalyst for the change. I mean, currently indebtedness is going up, but so is the rest of the economy. It's just sort of drifting along. Yeah. So what's the catalyst for this to all change?
Normally there aren't catalysts. Normally it's internal dynamics that lead to this in the first place. But the catalysts do exist this time around. Of course, it's declining terms of trade. We've been on the biggest price bubble ever in our resources. They're heading down. The export volumes are still rising, but they're not going to continue rising at the same rate. The investment that gave us the mining boom is over, and I'd actually like to see disinvestment in the mining sector coming forward. And the government still, like most governments around the planet, frankly, are stupid about the economy. They're obsessed about running government surpluses when that's bad economics. So those are factors, those are trigger factors which can make things worse. But the basic internal dynamic is that booms are caused by rising credit and collapses are caused by falling credit. And credit rises when debt's low. When debt gets to be extreme, people stop borrowing, credit therefore falls, and you have a downturn.
So what does it mean for house prices then if we do see this happen next year sometime?
Well, the one wild card for house prices is foreign buying. And in some ways that's actually been turned off right now. I can very easily see the government turning foreign buying back on again if they see house prices falling, because Australian government policy, of course, is to have expensive, affordable housing. But leaving out the Chinese factor, because demand for housing comes from new mortgages, that's what sustains the price level. So it's not the change in mortgage debt that actually drives the change in house prices, it's whether that change is rising or falling. And we're now seeing decelerating mortgage debt, and that is driving house prices down. Now, it's happened everywhere else in the world. It's happened. House prices have fallen between 20 and 70%. Okay? So somewhere in that range we're going to see that sort of fall. And we do have, according to all the figures, the most overvalued housing on the planet, with the possible exception of Hong Kong.
Unemployment?
higher, has to rise. And again, this is a very strong relationship. When I look at the relationship between credit in America and unemployment in America, if people know their mathematics, which I know most people don't, its correlation is pretty close to -1. It's as high as you can possibly get. So when credit falls, unemployment rises. Now the government will spend in that case. Malcolm Turnbull will become what I call a Groucho Marxist. That is where you say, these are my principles, if you don't like them I have others, and they'll abandon the drive for a surplus, and government spending will attenuate the downturn. But we will still see a downturn before that happens.
Last time you made a really bold call on the Australian economy, you lost a bet and had to walk from Canberra to Kosciuszko. Have you got your hiking boots ready?
No, not this time. I've already done the hike, and that bet was over house prices falling 40% over 10 to 15 years, made in 2008 in Parliament House, just after the government had brought in what they call the first-time owners boost, and I call the first-time vendors boost, because it drive house prices up, and it's deliberately intended to do that. So, you know, little factors like that weren't taken into account by the other side of the bet. I did the walk to shut them up. I've done the shut up. Now I'm still saying we've driven house prices far too high. It's all been credit that's done it. They'll come down when credit falls. Unless we're lucky and Chinese people trying to get their money out of China drive house prices up again. But equally, Xi, being rather Stalinist, could drive prices down by making them repatriate.
But alternatively, that doesn't actually stimulate the economy, doesn't it? That just props up house prices.
Well, it does actually stimulate the economy, and this is partly why we've got away with it, because any form of money coming into the economy gets spent. Whether you buy some of those goods, buying goods and services or buying existing assets, you're still causing part of the turnover. And if you buy a house off somebody, they're going to buy, you know, an automobile, etc., etc. So the cash does turn over. So we have benefited out of that cash inflow. But the same thing has happened in Vancouver, it's happened in London, happened in Sydney. It's made the prices unaffordable for locals, and it becomes a justified and large political issue in that situation.
You've said that growth depends on debt growth always exceeding GDP growth. Can you break that down? What do you actually mean by that?
What I'm saying is that credit's a necessary part of a well-functioning capitalist economy. Okay? But credit itself depends upon how willing you are to borrow to invest, fundamentally. And even if you have all that investment done for sensible reasons, people borrowing to build factories and so on, they can accumulate money, they can borrow money during a boom to finance that investment and then have to repay part of it during a slump. So what you have is there's less cash flow than they thought they'd have to repay it, and then it ratchets up and ratchets up and ratchets up. And that's what we've seen across the whole globe now. And Australia's been an exemplar of that particular pattern, ratcheting higher and higher and higher. Ultimately, the only way out of this is to write that debt off, write the private debt off, which we have the capacity to do, but people resist that because they say you should pay your debts, as if it's responsible, banks have been responsible in creating that much in the first place. So it is just a ratcheting up effect, and we've reached the maximum level of that ratchet.
Can we avoid all of this? Can we avoid a recession in 2017?
We'd need an enormous government stimulus. So the deficit would need to be, say, 10–15% of GDP. We'd need to have massive foreign buying of housing to enable the cash flow to come in from that. And we'd need to be lucky with our exports. But I don't think we're going to see those three factors happening. Of course, the government's going to make things worse, the experts will make things worse, and the foreign buying, of course, has become too political an issue, and justifiably so. Pushing
out the deficit, doesn't that just make more problems further down the track?
This is one of the myths that I'm trying to get out of people's heads, because that is a piece of logic that it says the government over the long term should have a balanced budget, a budget of zero. The government is not like a household. The government is like a bank. Now, a government running a balanced budget is like a bank that simply lends back as much as it gets in repayments. Therefore, the money supply never grows. Without a growing money supply, you don't have a growing economy. It has dilemmas. There's problems with private debt on one side and potentially government deficits causing a trade deficit on the other. But you do need a growing money supply. That means banks should normally lend more than they get back in repayments, and government should normally spend more than they tax. We've got our thinking completely wrong about this, and it's almost like trying to explain the universe to people who believe that the Earth is the centre of the universe, and you're trying to explain a moonshot to them. We have to change our thinking. Government should run deficits most of the time.
How big would you be comfortable in that deficit going then? So should we just completely blow out?
No, no, no. Again, it's a question of what are the impacts of that. So in the Australian situation, the main deficit we should be worrying about is our trade deficit, which is enormous. And if you have a large government stimulus, then a lot of that could spill over into imports, and you'd have an even worse impact on the balance of trade, and you'd affect your currency and so on. So you have to make those sorts of decisions. But at the same time, for example, we have central banks around the world trying to cause inflation. Now, aren't they doing a brilliant job? Okay? If we actually use the government running a deficit and thereby putting money into the economy, we could generate that inflation. It would then be a question of how much inflation do you want? You'd need to make decisions like that rather than being blanketly opposed to deficits and blanketly obsessed with running a surplus, which is just bad economics.
Many have called on governments like the Australian federal government to start pumping money into real and vital infrastructure rather than just pumping it into markets, which has happened in the US, etc. Would that help?
That would help, and it's again, it's a question of what the projects are themselves to some extent, but the government doing that as a way of creating money and then stimulating economic activity is a sensible thing. What they've been doing instead, of course, with quantitative easing is pumping up asset prices when high asset prices were part of the problems to begin with. So it is more sensible to use that government capability to run infrastructure than it is to blow up the prices of AMP shares.
So should the Australian government be going out and making that argument? Like, who do you think is failing here? Is it the electorate that squeals about a deficit because we believe that is bad, or is it the fact that politicians aren't executing policies well enough?
It's because economists have informed them both badly. Economists, not mainstream economists, I distinguish myself from them quite seriously, but they've pushed this whole idea of the government being like a household. They've pushed the idea the government should run a balanced budget or a surplus over time. This is the extreme mainstream, the real true believers in the middle of the mainstream theory. They've pushed that. So consequently, the politicians get badly advised, and the public does the same thing they used to do back in the 1500s, look up in the sky and say, obviously the Earth must be the centre of the universe. Look, the sun circles around us every day. If you get a bad theory guiding how you think about the world, then you're going to have bad decisions made and believe you're making the right decision. So it's the fault of the economics profession.
How about the Reserve Bank? What is their role in this, and do you believe that they should be cutting interest rates again?
They are part of the problem. The Reserve Bank is very much conventional mainstream thinking, and they don't even realise the role of private debt in the economy. They've pumped up this debt bubble deliberately. They actually cut rates in the hope that that would cause investors to go into the housing market.
Well, many would say that the RBA has been extremely steady guiding hand throughout the past couple of years, and then
steady guiding hand straight towards the shoals.
They have also encouraged banks to, pull back on lending to investors and to households.
They still don't know what they're doing. The Reserve Bank is the mainstream thinking about the economy that ignores the role, believe it or not, of banks' debt and money in muddling the economy, and yet they've got their hands on the lever of the monetary system. So the Reserve Bank, I think, I'm very much a fan of the Bank of England. The Bank of England has a much better idea of how the monetary system functions than any other central bank on the planet. At the other extreme, I would put the Reserve Bank of Australia.
The growth of Australia and how we've performed over the last couple of years would sort of go against that, wouldn't it?
In the meantime, our debt level, according to Bank of International Settlements figures, private debt has gone from 150% of GDP to 210% of GDP. So a large part of that apparent growth of the economy has been a 60% of GDP increase in our debt level. That's been under the Reserve Bank's watch. That's been why we're congratulating ourselves on doing so well. Ireland did the same thing when they called themselves the Celtic Tiger. They don't call themselves that anymore. Spain was doing the same thing during its housing bubble. We've replicated the same mistakes when we've had time to observe and see them being made by other countries. So it's even worse for us. We're the last idiot on the block.
So Australia, you predict to go into recession possibly next year. Who else do you think will be going there with us?
Canada. Canada's done a very similar thing to us. Korea's also got a housing bubble going on. The debt levels in all those three countries private debt are about 210% of GDP and still rising. Other possibilities in China, of course. China's done the same thing, but China is such a mess of a private and public system together that they can basically flip from private sector monetary stimulus to government without you even knowing they'd done it. So they have some potential to push forward, but they certainly have a crisis coming their way, however they might manage it. Norway, Sweden are also on the list.
How do you prepare if you're Australian, you're a superannuant, you have a home, possibly an investment property? What do you do?
Well, the trouble is the way individuals prepare causes the boat to sink, because the way individuals prepare for this thing is not to be in debt. Now, if you liquidate your assets and get out of debt, then you cause the asset price, you contribute to asset prices falling, and you, by reducing your spending below your income level, you actually cause that credit to fall. So unfortunately, it's not a sort of thing we can solve at the individual level. We cause it that way by collective action. But individuals, if they want to protect themselves, should have as low a level of leverage as they can possibly manage.
Professor Steve Keen, thanks very much for joining the program.
It was lovely to be here.